afternoon to everyone. In the last class, I did discuss that we'll be starting from tax planning relating to husband and wife, and after that, we'll be starting, inshallah, property income. Okay, let us do something discussion on tax planning. Obviously, this tax planning is between husband and obviously wife. Actually, the tax planning is, for example, if any one of them is having dividend income and other one is not having dividend income, okay, assuming husband is having dividend income of 4,000, okay, and let's say wife does not have any dividend income, in that case we will give advice to the husband that he should transfer some of the dividend income to wife, which is at least 2,000. The benefit would be, if husband is going to transfer 2,000 dividend income to wife, then husband is going to get the nil rate band of 2,000 and wife will be getting the nil rate band of 2,000. So in this case, this couple will not be paying any tax on dividend income. So if husband transfers 2,000 of dividend income to wife, then husband will get nil rate band for 2,000, wife will get nil rate band for 2,000. So simply in this way, couple is not paying any tax on this dividend income. Another tax planning between husband and wife could be on saving income, interest income. For example, let's say, assuming husband is an additional rate taxpayer. If husband is an additional rate taxpayer, then obviously whoever is an additional rate taxpayer does not get nil rate band on saving income. So assuming husband is having saving income and he's also an additional rate taxpayer, and let's say wife does not have any saving income. In this case, we will advise husband he should transfer the saving income to wife. The benefit would be, if your wife is a basic rate taxpayer, she is going to get nil rate band of 1,000, and if she is having any space left in basic rate band, so tax rate is going to be 20%. Even his wife is higher rate taxpayer, still she is going to get nil rate band of 500, and tax rate is going to be 40%. So basically, tax planning can be done between husband and wife relating to dividend as well as saving income, interest income. The objective of this tax planning is very simple, just to save the tax for the couple, and it is perfectly acceptable, no issue at all. Let's apply this little bit discussion on this question number 7. It says, advise the couple of any beneficial tax planning measures they should make to minimize their combined income tax liabilities. Stan and Gia are a married couple for the tax year 21-22. They expect to have the following income. Look at this. Stan is an additional rate taxpayer. He is having employment income of 170, saving income of 2,000. He does not have any dividend income. Gia is having employment income of 2,000. She does not have any saving income, but she does have dividend income. Now listen and listen carefully. Obviously, look at the Stan. Stan is an additional rate taxpayer. Stan is not getting any personal allowance, because Stan's adjusted net income is far more than 1,25,140. Stan is having a saving income of 2,000. Now listen. We'll say, since Stan is an additional rate taxpayer, so he is not getting any nil rate band for his saving income. which means income tax on saving income 2000 into 45% results in 900. So simply, if Stan does not transfer his saving income, he will end up by paying £900 income tax on his saving income. But look at this, Gia. Gia, number one, is a basic rate taxpayer. Look at her income is just 23,000 before deducting personal allowance. So after deducting personal allowance, of course, Gia is a basic rate taxpayer. Since number one, she's a basic rate taxpayer, she will get nil rate band of 1,000. Second, uh, saving income will fall in the basic rate band, so where the Gia is going to pay tax only 20%. Now listen, let's solve here. Let me clean this space a little bit. Should be cleaner. If Stan transfers saving income to Gia, then income tax liability, on saving income. First 1,000 nil rate band is available. Second 1,000 will fall in basic rate band where the tax rate is 20%. So it's going to be 200. So very simple. If Stan does not transfer his saving income to Gia, then Stan will have to pay income tax 900. By transferring his saving income to his wife, wife is going to pay income tax only 200, which means that there is going to be a saving of 700 due to transfer of saving income from Stan to Gia. Couple saves £700 tax. So there's going to be saving of £700. Wow. Let's do more planning. Look at this. Stan does not have any dividend income. Okay, which means Stan is still having a nil rate band of 2,000. Because when it comes to dividend income, every individual gets nil rate band of 2,000 irrespective of their tax paying status. Okay. Gia is having dividend income of 3,000, which means that if Gia transfer just 1,000 dividend income to Stan, so Stan will be getting a nil rate band. So in this way, if Gia transfer just £1,000 dividend income to Stan, then in this way couple will not be paying any tax on this dividend income. So look at this. Dividend income, if Gia does not transfer dividend income of, let's say, just £1,000 to Stan, then income tax on dividend income So actually she is having a dividend income of 3,000, which means that first 2,000 qualifies for nil rate band. Remaining 1,000 it falls in basic rate band where the tax rate is 7.5%. So Gia will end up by paying income tax liability of £75 on this dividend income, which means that if Gia just transfer £1,000 to Stan, then income tax liability on dividend income becomes nil. How? Look at this. Actually, couple is having total dividend income of 3,000. Gia will get the nil rate band of 2,000. Husband will also get the nil rate band of 2,000, but husband will be having only 1,000. So obviously, entire 1,000 falls in nil rate band. So in this way, Gia will get nil rate band of, this is for Gia. Gia will get nil rate band of 2,000, 0. Stan 1,000 into 0% is obviously 0. So husband and wife, if they follow this tax planning, they will be paying no income tax on dividend income, which means that there is going to be a tax saving of 75. By transferring dividend income of £1,000 to Stan, couple saves income tax of 75. So actually, by following this little bit tax planning, on saving income, couple is going to save £700 income tax. On dividend income, couple is going to save £75, which means altogether there is going to be total tax saving of 775. If this couple follows tax planning, then income tax total saving is going to be 700 plus 75, 775. But one thing you need to remember is, please, they can only transfer saving income to each other, dividend income to each other. They cannot transfer employment income to each other. Okay, they can just transfer saving income, dividend income. They cannot transfer employment income. So this was a little bit relating to tax planning between husband and wife. I strongly believe now you have a really good idea what sort of tax planning I was talking about in this question. Now let us go and start all together the new topic. The name of the topic is property income. Okay. Now you people are having a really good idea of how to calculate income tax liability. Second, you have a really good idea about minor child income. Second, jointly owned property, what to do with that. We have discussed that also. And finally, we have just discussed tax plannings relating to husband and wife. Now we are starting a proper topic, which is property income. It's a very small topic, but we need to know. Actually, here, property income means rental income. We are not studying right now that someone has bought the property and then he's selling the property. Because if someone buys the property, then sell the property, then it is going to result in capital gain. We are not studying right now capital gain. Right now we are studying the scenario of rental income, means someone has bought the property and then that individual or that company is given that property on rent. Okay, so we are studying right now rental income. Number one, for individuals, for sole tradership partnership, property income is calculated on cash basis. The first question is, what do you mean by cash basis? Cash basis means actual cash which you have received from the tenant, only that will be considered. So cash basis means in the relevant tax year, whatever rent you have received, even you have received in advance, that rent is going to be taxable, and from that rent you have to deduct all allowable expenses, but only those expenditures, those expenses which you have paid, because we are working on cash basis. So we are going to take receipts and we'll be deducting expenses, but on payment basis. The cash basis now is the default basis for calculating property income for individuals and partnership. However, it is still possible to opt to use the accrual basis. That is still possible that you may opt accrual basis. But listen and listen carefully. When nothing is mentioned in the question for individual, we will always take cash basis. We will always assume cash basis. Okay. An accrual basis must be used if the property income receipt exceeds. If someone is having, let's say, number of properties which that person has given on rent, if the total gross income from that from those properties exceed 150, 1,50,000, in that case, instead of cash basis, you will have to go for accrual basis. Otherwise, nothing is mentioned. For individuals, we will always go for cash basis. But when it comes to companies, companies still follow accrual basis only. Okay. Now the question is there are some of the concepts which are same, either you are following cash basis or accrual basis. For example, security deposit is security deposit. It's not your income. Either you are following accrual basis or cash basis. Replacement furniture relief. Either you are following cash basis or receipt, cash basis or accrual basis. Replacement furniture relief concepts remain same. The question is, what do you mean by replacement furniture relief concept? We will discuss after maybe 2 to 3 minutes. Just wait for a minute. Relief for property income losses is same. Premium receipt concept is same. Restriction on finance cost. Basically, either someone is following cash basis or accrual basis. There are some of the concepts which are same in both, either cash as well as accrual basis. So each concept we will be discussing in detail, but you have to wait for that, please. Let me tell you what do you mean by use of mileage allowance. Now, what is this concept? It is very much possible that owner has used his own car to find out tenant. Second, it is also possible that owner has used his car for relating to that property which owner has given on rent. According to HMRC, expenditure relating to that car which was used for this property which has been given on rent, actual expenses on that car, they are not deductible. They are not deductible. Instead of giving actual expenditure as allowable which employer has incurred on the car, HMRC says will give you mileage allowance. So by using mileage allowance limits, you can calculate deductible expense. Now the question is, what do you mean by mileage allowance limit? So let me explain this. What is this AMA? Authorized mileage allowance. You can also say approved mileage allowance. Now listen and listen carefully. According to HMRC, first 10,000 miles, the rate is 45 pence per mile. Above 10,001 plus more is 25 pence per mile. Now, there is a simple question is, sir, when I'm going to use these limits and how I'm going to use these limits? Now, the answer is, let's say Mr. X, who is the landlord of the property, assuming Mr. X is the landlord of the property which he has given on rent, and your examiner says Mr. X has driven his car 15,000 miles for business property income. Okay. Now, whatever income, whatever rent we have received, we need to deduct authorized mileage allowance. How we are going to calculate the amount of authorized mileage allowance? Please listen. Number one, you have to take rent, whatever it is, as inflow. From this, I will deduct car allowable expense. How I'm going to calculate this? Since Mr. X has driven 15,000 miles his car for this property, which is given on rent. So for first 10,000 miles, you have to just multiply with 0.45, and then remaining 5,000 miles you have to multiply with 0.25. So which means that it is coming 5,750. So simply we will deduct 5,750 from the rent which we have received. So if owner has used his car for the property which is given on rent, then actual expenditure on that car are not deductible. We will calculate deductible expense, but by using authorized mileage allowance limit. And the limit is for first 10,000 miles, it is 45 pence, and after that, it is 25 pence. Okay. So what it says, individual and partnerships can now use HM revenue and customs approved mileage allowances when calculating property income. This is an alternative using the actual motor expenses. So leave the actual motor expenses and deduct authorized mileage allowance. In property income, we'll be discussing obviously rental income. We'll be discussing this is head lease and normal is what it is. Rent a room relief we'll discuss also. Look at the format. Property income deals with rental income assessed on cash basis for individuals, for individuals and partnership it is for cash basis. For companies, it is on accrual basis. You have to take property income, rental income, less allowable expenses like repair and maintenance will deduct advertisement, agent fee, insurance charges, motor rates, bad debts. Normally, if we are working on cash basis, then bad debt will be automatically adjusted. How? Because we will only take rent received. So bad debt will automatically be adjusted when you are working on cash basis. Okay, you have to deduct council tax, redecoration means revenue expenditure. You have to deduct that also. Replacement furniture relief you have to deduct. Now let me explain what do you mean by replacement furniture relief, and after deducting this, you will be having taxable property income. So let me first explain replacement furniture relief. What is replacement furniture relief? Let us discuss this, a very simple concept. The name of the concept is replacement furniture relief. Now, look at the name. Name itself suggests it is this relief is only available when you are replacing furniture items, which means that initially when you bought the furniture item, you will not get a replacement furniture relief. Replacement furniture relief is only available on replacement. It is not available when you are buying first time. So it is not available on initial cost of furniture items. It is only available when you are replacing your existing furniture item. And when it comes to furniture, there are so many things which they come in furniture, like it's going to be even your television, sofa set, all these things they come in furniture. Even washing machine comes in furniture. So let me explain. Initially, whatever price you have paid, it is not taken as replacement furniture relief. Replacement furniture relief is only available on replacement of the asset. And let's try number one. A. Let's say Mr. X is having an old washing machine with scrap value of let's say 200 pound. Mr. X replaces this machine with new machine costing 800 with similar but of course new machine costing 800 pounds. Now since you have replaced your existing washing machine, you have replaced the furniture item, now you will be getting replacement allowance. But now replacement furniture relief will not be 800, it's going to be 600. Why it's going to be 600? Because the new machine, it has costed you 800, but the point is the existing old machine, you're not selling it for free. You're getting a scrap value of 200, which means if there is an outflow of 800, but there's simultaneously an inflow of 200 as well, which means that replacement furniture relief is 600, which means that from the property income we'll be deducting 600. We are not supposed to deduct 800. From property income we'll be deducting this 600. Let's go for case 2. Case 2, assuming scrap value of existing machine is 0. Just for the sake of discussing one more variety, I'm just assuming that the scrap value of existing machine is 0. Now listen and listen carefully. If a scrap value of existing machine is 0 and we are replacing existing machine with a similar machine, but obviously the new one, which is costing 800 pounds. Since existing machine does not have any scrap value, which means that replacement furniture relief will be 800. Now, in case 2, replacement furniture relief. Replacement furniture relief is going to be 800. Why 800? Because scrap value of existing machinery is now 0. So from the property income, we'll be deducting this 800. Now let's go for third variety. Let's say scrap value is 100 of old machine, which is replaced with a new washing machine having dryer also, costing 1200 pounds. Let's say the new machine with the dryer is costing 1200 pounds, and assuming existing machine did not have any dryer, then what happens in question exam? I will give you more information that if so, basically the new machine is having a dryer facility as well, and existing machine was not having dryer facility. It means that the new machine which has a dryer facility, that dryer facility will be considered as a capital expenditure. So actually we need to replacement furniture relief means you are replacing your existing furniture item with similar new item in the market. So since existing machine was not having a dryer facility, new machine is having a dryer facility. So this dryer facility amount, whatever it is treated as a capital expenditure. So now what happens? Examiner will give you more information. If similar new machine, look at this, similar new machine is having value, let's say 1100. So similar new washing machine is having a value of 1100. So now replacement furniture relief is going to be 1000. Why 1000? Because existing machine is having a scrap value of 100 and similar new washing machine is having a market value of 1100, which means that replacement furniture relief. So basically, this individual is going to deduct 1000 pound from his property income. So now I strongly believe you have a really good idea of replacement furniture relief. So now what is this property finance income cost? Now listen and listen carefully. What is this finance cost concept? Number one, it is very much possible that owner has taken the loan and from that loan he has bought the property which is given on rent. Okay. So one possibility, someone takes the loan, buys the property and then gives that property on rent. Second possibility, it is also possible that someone has taken the loan for the property but not buying the property. For the property, just for the sake of capital expenditure, even for the revenue expenditure on that property. So if someone takes the loan to buy the property, number one, and then give the property on rent, or second, the property is already bought, which is already on rent, someone takes the loan in order to incur capital expenditure on that property. Even someone takes loan in order to go for revenue expenditure on that property. So in that case, in all the cases, either someone takes the loan and then buys the property. Second, someone takes the loan and go for capital expenditure in the property. Third, someone takes the loan. Let's say landlord takes the loan and by using that loan, landlord goes for revenue expenditure. In either way, you are taking a loan relating to the property and you have given that property on rent. So in that case, finance cost will not be deducted. Finance cost will not be deducted from property income format. Look at this, allowable expenses. I do not have any finance cost. So what to do? Basically, uh, if someone is taking the loan for this property, what do you have to do? Number one, you ignore that thing. Second, you just calculate your income tax liability. So whatever your income tax liability comes from that liability, you need to deduct prop. You need to deduct finance cost relief. What is this finance cost relief? Whatever is the amount of the interest, multiply that amount of the interest with the basic rate which is 20%, and whatever it comes, you need to deduct that from the income tax liability. So let me explain what I really want to say with the help of a question. Look at this question number 8. On 6 April 2021, Fang purchased a freehold house. The property was then let throughout the tax year 21-22 at a monthly rent of 1000. At a monthly rent of 1000 means for the entire year they have received 12,000. Fang partly financed the purchase of the property with a repayment mortgage, paying mortgage interest £4,000 during the tax year 21-22. Number one, this 4,000 will not be deducted from the property income. Okay. The other expenditure on the property for the tax year 21-22 amounted to 1,300 and this is all allowable. Fang is having a salary of £80,000 as well. We need to calculate Fang's income tax liability. Okay, so let's try. Rent 1000 into 12 is obviously 12,000. From this rent, what we have to deduct? We have allowable expenses of 1,300. Allowable expenses of 1,300. So we'll deduct allowable expenses of 1,300. Now what? Now what? We are not supposed to deduct Finance cost, while calculating property income, you're not deducting this finance cost. That's it. We'll have property income, and then we simply add salary 80,000 because it is also a non-saving income. So we do not have any other item of rental income. Okay. So here comes your property income. This guy is having a salary, that is employment income of 80,000, which means total income is 90,700. Personal allowance 12570. So I will have taxable income. $78,130. So there's a taxable income of 78,130. Now let's calculate tax. Obviously, property income as well as employment income both falls in non-saving head. We need to calculate income tax on this 78,130. So first basic rate is 37,700 into 20%. Let us see what we are getting. 37,000. We are getting 7,540. From this 78,130, you need to deduct 37,700. From 78,130, you need to deduct 37,700. So you will be having you are having a higher rate. From 78,130, if I deduct 37,700, I'll get 40,430 into 40%. So we'll get 16,172. Before calculating the final answer, okay, you have to just deduct finance cost relief. Finance cost relief. They have given 4,000 interest in this question. You need to multiply this interest with basic rate, which is 20%, so 800. Your finance cost relief is 800. So here comes your income tax liability. Here comes income tax liability. 7540 plus 16,172 minus 800. So I'm getting 22,912. So income tax liability is 22,912. So basically, you are not supposed to deduct finance cost from the property income. What you have to do, just calculate your income tax liability, and before the final answer, you just need to deduct finance cost relief. Whatever finance cost amount is, just multiply that amount with the 20%. Whatever comes, deduct that from the income tax liability. So due to this 800, we have actually now the income tax liability has reduced to 22,912. Okay. Look at this replacement furniture relief. We have discussed that replacement furniture relief is technically not available on initial cost. It is only available when you are replacing the furniture item. And furniture item means what? There's so many things they fall in the furniture. Look at this: beds, television, fridges, freezer, carpet, curtains, floor covering, washing machines, cooker, cutlery, crockery. All they come in furniture items. There's no relief for initial cost. When you are buying first time a furniture item, then there is no replacement furniture relief, because look at the name. Replacement furniture relief is only available when you are replacing the existing furniture item. There is only relief when assets are replaced. Also, relief is not given for any cost which represents an improvement. If there is a capital expenditure, then you will be not getting any relief against that capital expenditure. The amount of the relief is reduced by any proceed. If we are replacing existing old machine with a new one, an existing machine is having this scrap value. Due to that scrap value, replacement furniture relief reduces, which we have seen also. Question number 9, I'll come to that. Just a minute. I want to discuss one thing. No. Okay, let us discuss first this question. Then we'll be discussing other things. In fact, I want every one of you pause the video, attempt this question, then of course you can unpause the video. On 6th April 2021, Frank purchased a freehold house. The property was then let throughout the tax year. Monthly rent is 800, which means multiplied by 12. So rent we have 800 into 12 gives us 9,600. During April 2020, Frank furnished the property with a cooker costing 440. We have just discussed when you are initially buying this furniture item, then replacement furniture relief is not available because replacement furniture relief is only available when you are replacing your existing furniture item with a new one. So this 440 is not available as replacement furniture relief. Washing machine 330. We are buying first time. Floor covering. It is also first time. The cooker was sold during the year December 2021. Okay, this is actually 2021 for 1 lakh for 110. Actually, existing cooker was sold for 110, which means existing cooker is having a scrap value of 110 pound. Replaced with a similar model costing 460. Very important. Replaced with a similar model costing 460. 460 is not available as replacement furniture relief because existing cooker is having scrap value of 110, which means from this 460 I have to deduct this 110, so there is going to be replacement furniture relief of 350. From this 460 I have to deduct scrap value of existing machine, so actually the relief is 350. The washing machine was scrap with nil proceeds, so there is another furniture item which does not have any scrap value. During March 22, it was replaced by a washer dryer costing 670. Although the cost of the similar washing machine would have been 360. Very important point. Existing machine was replaced with a new machine but having a dryer facility, and existing machine did not have any dryer facility, which means that this a machine with a dryer is not suitable for us. We need to find out what would be the cost of a similar model. So it is given to us. Although the cost of a similar washing machine is 360. So for washing machine, actually we'll be getting a replacement furniture relief of 360 because existing machine does not have any scrap value. So the other expenditure on property tax year 21-22 amounted to 1310, and this is all allowable. So other allowable expenditures the examiner has given us 1310. Let us first deduct replacement furniture relief. Replacement furniture relief. Cooker. New cooker was bought for 460. Existing was having a scrap value of 110, which means 350. Washing machine. $360 because old machine does not have any scrap value. Other allowable expenses 1310. So here comes your property income. 9,600 minus 350 minus 360 minus 1310. So property income is 7,580. Property income is 7,580. So I strongly believe now you have a really good idea relating to property income. We need to discuss few more concepts. Let us discuss another concept, and the name of the new concept is premium. When let's say the owner. When the owner gives his property on short-term lease. Short-term lease means less than equal to 50 years. When owner gives his property on short-term lease, and what do you mean by short-term lease? Actually, short-term lease means the time period is less than equal to 50 years. Then what happens? Whatever premium owner has received, we need to deduct relief from this premium. I'm just explaining what do you mean by premium. Just wait for a minute. From this premium, we deduct relief, which is 2% n minus 1 into premium amount. Just deduct this. So you will get taxable premium. What is this n? N is the lease term. So when owner gives his property on short-term lease, then whatever premium he has received from this premium, we deduct the relief. Then whatever comes, it is taxable premium. Another question is, what do you mean by this premium? Actually, whatever premium owner has received, it is non-refundable. But the question is, why someone is going to pay us premium in addition to the uh, rent? Premium is paid only once. Getting premium along with rent, there is only one reason. The reason is then your property must be at a very good place. It is situated at a very nice place. Just the location is so good that your tenant is willing to pay you premium rent as well as premium also. So whatever premium owner has received, from that premium we will deduct the relief, which is 2% n minus 1 into premium amount. So after deducting the relief, you will be getting taxable premium. Let me repeat, logically the premium, you will only be getting the premium when your property is at a very good location. Okay, how to deal with that? For example, let's say Mr. X has given his property on rent, okay, on short-term lease. The lease term I'm taking is 25 years. Okay, Mr. X received the premium. Let's say he has received the premium 40,000. We are required to calculate taxable premium for this Mr. X. We need to calculate taxable premium for Mr. X. Very simple. Just first write the amount of the premium and deduct the relief, which is less relief, which is 2%, n minus 1, this time n is 25 into this amount of the premium. Let me use the calculator. It is 19,200. So from 40,000, I have to deduct 19,200. So I'm getting taxable premium 20,800. This taxable premium means Mr. X, who is the landlord of this property which he has given on rent, since Mr. X has received this 40,000 as premium. So taxable premium for Mr. X is 20,800. This 20,800 will increase property income for Mr. X. So all you need is, if you have taken premium as well for a short-term lease means the time period is less than equal to 50 years. Then whatever premium you have received, from that premium you need to deduct the relief. How do we calculate relief? It is very simple. 2% n minus 1 into amount of payment. Okay, dear student, in the next class I'll be discussing the remaining part of the property income. It is not a very big topic. In the next class, inshallah, our property income will be completed. And after property income, we will start the very small and important topic of pension. And after pension, we'll be doing a very small, tiny topic of NIC, National Insurance Contribution, and then inshallah, employment income. So thank you very much for watching this lecture. Have a nice life.